What if the stock market is giving investors one of the biggest buying opportunities of the year, and most people are too scared to take it? Right now, several strong companies are trading at prices that could look very different a few years from now. But here's the important part. Not every falling stock is a bargain. Some stocks are falling because their businesses are getting weaker. Others are falling because investors are simply overreacting. And that difference could determine whether you make a smart investment or buy a stock that keeps falling. Today we're looking at 5 stocks worth putting on your watch list while this market weakness lasts. And the 5th one could be especially interesting if you're looking for long-term growth. Let's get into it. Number 5 is Amazon. Amazon isn't just an online shopping company anymore. Its business has expanded into cloud computing, digital advertising, artificial intelligence, logistics, streaming, and a massive global consumer ecosystem. The biggest opportunity may come from Amazon Web Services. Cloud computing continues to become more important as businesses move their operations online and invest heavily in artificial intelligence. Amazon also has another advantage: scale. Its enormous customer base gives the company multiple ways to generate revenue from the same users. Advertising is one example. Amazon can monetize the millions of people already shopping on its platform without needing to build an entirely separate audience. Of course, Amazon isn't risk-free. Its valuation can become expensive, competition remains intense, and huge investments in AI and infrastructure require massive amounts of capital. But if the stock experiences a meaningful pullback while the underlying business remains strong, that could create an interesting long-term entry point. For investors willing to think several years ahead, Amazon deserves a spot on the watch list. Number 4 is Alphabet. The company behind Google has one of the strongest positions in digital advertising, search, YouTube, and cloud computing. But the reason Alphabet is particularly interesting right now is artificial intelligence. AI is changing how people search for information, create content, and interact with technology. That creates a major challenge for Google's traditional search business, but it also creates a massive opportunity. Alphabet has enormous amounts of data, world-class AI research, powerful computing infrastructure, and a huge ecosystem of products. Google Cloud is another important piece of the story. As companies spend more on AI infrastructure and cloud services, Alphabet has an opportunity to capture more of that spending. The market may continue questioning whether AI will hurt Google's traditional business. But if Alphabet successfully integrates AI while maintaining its advertising dominance, investors could potentially be looking at a very powerful combination of growth and cash generation. So when Alphabet sells off because of short-term fears, it's worth asking one simple question. Has the business actually become weaker, or has the stock simply become cheaper? That distinction matters. Number 3 is Nvidia. Nvidia has become one of the most important companies in the artificial intelligence boom. Its chips power many of the world's most advanced AI systems. And demand for AI computing has created enormous growth for the company. But here's the problem. Expectations are extremely high. When a company becomes one of the biggest winners in the market, investors often start pricing in years of future success. That means even a great company can become a bad investment if you pay too much. That's why a significant Nvidia pullback could become interesting. The AI infrastructure build-out isn't disappearing overnight. Companies around the world are still spending heavily on data centers, computing power, and AI systems. Nvidia also has a powerful software ecosystem surrounding its hardware, which makes its competitive position harder to challenge. The key is patience. Instead of chasing the stock after huge rallies, investors may want to wait for periods when fear creates a better entry price. Because sometimes the best opportunity isn't finding a great company, it's finding a great company on sale. And if you're enjoying this breakdown, take a second to like this video. It helps the channel reach more investors who want simple, long-term stock analysis. And if you haven't already, subscribe to the channel because we're covering more market opportunities, undervalued stocks, and important economic trends. Now let's move to number 2. Number 2 is Microsoft. Microsoft is one of the clearest ways investors can gain exposure to the AI revolution while still owning an enormous and diversified technology business. Its cloud platform continues to play a major role in enterprise computing. Its productivity software reaches millions of businesses and users. And artificial intelligence is being integrated across its ecosystem. That's important because Microsoft doesn't need to create an entirely new business to benefit from AI. It can add AI capabilities to products people are already paying for. That could potentially increase revenue per customer while strengthening Microsoft's ecosystem. The biggest concern is valuation. Investors already know Microsoft is a high-quality company. That means the stock can remain expensive even during market weakness. But if the price falls significantly, while earnings and long-term growth expectations remain intact, Microsoft could become one of the more attractive, large-cap technology stocks to consider. This is the kind of company where patience can matter more than prediction. And number 1 is Meta Platforms. Meta owns some of the world's biggest social platforms, but the investment story goes far beyond social media. The company has a massive advertising business. It has billions of users across its ecosystem, and it's investing aggressively in artificial intelligence. AI can potentially improve advertising recommendations, content discovery, user engagement, and the efficiency of its platforms. That matters because even small improvements in advertising performance can become significant when you're operating at Meta's enormous scale. But there's another reason Meta is interesting. The company has historically shown that it can adapt. Its business has gone through major changes, and management has repeatedly invested heavily in new technologies and infrastructure. The risk, again, is valuation and massive spending. AI infrastructure requires huge capital investments. If spending rises faster than revenue, investors could become nervous. But if those investments increase productivity and advertising revenue over time, the payoff could be substantial. So if the market gives investors another major pullback in Meta, it may be worth taking a closer look. So the 5 stocks we're watching are Amazon, Alphabet, Nvidia, Microsoft, and Meta Platforms. But remember, a falling stock isn't automatically a cheap stock. The goal isn't to buy simply because the price dropped. The goal is to identify strong businesses, understand the risks, and wait for a price that makes sense for your strategy. Because market fear can create opportunities, but only for investors who are prepared. If you found this video useful, like the video and subscribe to the channel for more stock market breakdowns. And remember, always do your own research before investing. See you in the next video.